What are the best REITs to hold inside a Roth IRA? And more importantly, what tax advantage do most investors completely miss? At first, the idea sounds simple. REITs pay income. Roth IRAs can offer tax-free qualified withdrawals. So putting REITs inside a Roth IRA seems like an obvious win. But the real answer is more nuanced. A Roth IRA can make REIT income more powerful. It can help dividends compound inside a tax-advantaged account. And it can be especially interesting for long-term investors who want real estate income without constantly creating taxable income in a brokerage account. But there is a catch. A Roth IRA does not make bad REITs good. It does not protect you from overpaying. It does not protect you from weak tenants. It does not protect you from falling AFFO, and it does not protect you from poor dividend coverage. So in this video, we're going to look at the best types of REITs to consider inside a Roth IRA, the tax advantages many people miss, and the mistakes that can turn a good account into a bad investment decision. A Roth IRA can make REIT income more powerful, but it does not make bad REITs good. To understand why, we need to start with why a Roth IRA changes the math. A Roth IRA changes the math because the account can change the after-tax outcome. The REIT business itself does not change. The properties are the same, the tenants are the same, the rent collection is the same, the balance sheet is the same, but the way the investor experiences the income can be different. If Roth IRA rules are followed, qualified distributions can be tax-free, and Roth IRAs generally do not require required minimum distributions during the original owner's lifetime. That matters for REIT investors because REITs often distribute income. Inside a taxable brokerage account, that income may create taxes along the way. Inside a Roth IRA, the investor may be able to let those dividends reinvest and compound without the same annual tax drag, assuming the rules are met. That is the big idea. REIT dividends flow into the Roth IRA. They can be reinvested, the account can keep compounding, and the investor may have more flexibility later in retirement. The account does not change the REIT business, but it can change the after-tax outcome. Now let's look at why REITs can be less efficient in a normal taxable account. REITs can be less tax efficient in taxable accounts because REIT dividends are not always taxed like qualified dividends from regular corporations. According to NAREIT, REIT dividends can be classified as ordinary income, long-term capital gains, and return of capital. And for 2024, NAREIT reported that REIT common share dividends were taxed as 78% ordinary income, 9% long-term capital gains, and 12% return of capital. That breakdown matters. Ordinary income can be less tax efficient than qualified dividend income, depending on the investor's tax situation. Return of capital is not immediately taxable, but it can reduce cost basis. Capital gains have their own treatment. The point is not that REITs are bad. The point is that account location matters. A REIT can look attractive before taxes, but the after-tax return can look different. This is why many investors consider holding REITs in tax-advantaged accounts. The dividend you see is not always the income you keep, but tax efficiency alone is not enough. The next question is, what actually makes a REIT worth holding inside a Roth IRA? A good Roth IRA REIT is not simply the REIT with the highest yield. That is one of the biggest mistakes investors make. A Roth IRA is valuable space, so the REIT still has to earn its place. The first thing to look for is durable cash flow. The REIT needs tenants, leases, properties, and demand that can support the business over time. The second thing is dividend coverage. If the dividend is not supported by AFFO, the yield may be a warning sign instead of an opportunity. Then you want to look at AFFO growth, a strong balance sheet, real sector demand, dividend reinvestment potential, and reasonable valuation. That last part matters because even a great REIT can be a poor investment if the price is too high. The order is important. Quality first, tax advantage second. A Roth IRA can improve tax efficiency, but the REIT still has to be worth owning. Now let's move from the checklist to actual categories that may make sense, starting with the simplest one. The simplest way to own REITs inside a Roth IRA is not always picking individual REITs. For many investors, the simplest option is a broad REIT ETF. A fund like VNQ, the Vanguard Real Estate ETF, can provide diversified exposure to many real estate companies in a single holding. That can reduce single company risk. It can also make the real estate allocation easier to manage. Instead of asking which individual REIT will outperform, the investor is asking a simpler question. Do I want diversified public real estate exposure inside my Roth IRA? That can be useful for beginners. It can also be useful for investors who do not want to spend time analyzing AFFO, lease structures, tenant concentration, balance sheets, and sector cycles company by company. But a REIT ETF is not risk-free. It can still fall. It can still be sensitive to interest rates. It can still have sector concentration, and it can still underperform the broader stock market for long periods. A REIT ETF can be the simplest way to own real estate without picking individual REITs. But if you do want individual REITs, one of the first categories to understand is net lease. A monthly net lease REIT can be interesting inside a Roth IRA because the account may allow the income to compound more efficiently. Realty income is one of the most common examples investors look at. This is not a recommendation, but it is a useful case study. Realty income had portfolio occupancy of 98.9% at the end of the first quarter of 2026. It reported AFFO per share of $1.13 for the quarter, and its 2026 AFFO per share guidance was $4.44 to $4.44. Those numbers matter because they speak to occupancy, cash flow, and dividend support. The Roth IRA angle is simple. If an investor holds a monthly net lease REIT inside a Roth IRA, those dividends may be reinvested inside the account without the same ongoing taxable account drag, assuming Roth rules are followed. That can support long-term compounding. But the risks do not disappear. Realty income can still be sensitive to interest rates. It still has tenant risk. It still has valuation risk. And the dividend is only as strong as the cash flow behind it. Monthly income can be powerful inside a Roth IRA when the cash flow is durable. Now, let's look at a different kind of net lease REIT, experiential real estate. VCI Properties is another example, but the business model is different. VCI is often discussed as an experiential net lease REIT because its assets are tied to gaming, entertainment, and destination real estate. Again, this is not a recommendation. It is an example of a different REIT category that income investors study. In the first quarter of 2026, VCI reported total revenue of $1 billion. AFFO per share was 61 cents, and the company raised its 2026 AFFO guidance to $2.44 to $2.47 per diluted share. For a Roth IRA investor, the attraction is the possibility of long-term cash flow compounding. If the leases remain durable, the dividend is covered, and the business keeps growing, a tax-advantaged account can be a powerful wrapper. But there are real risks. Tenant concentration matters, gaming and travel exposure matters, regulatory risk matters, and valuation still matters. A Roth IRA can shelter income, but it cannot remove business risk. Now, let's move from income-focused net lease REITs to a category that can add more growth potential, industrial real estate. Industrial REITs can serve a different role inside a Roth IRA. They may offer income, but the bigger appeal is often long-term growth. Prologis is a common example in this category. It is tied to logistics, warehouses, supply chains, e-commerce, and the physical movement of goods. In the first quarter of 2026, Prologis reported core FFO per diluted share of $1.50. Its current 2026 average occupancy guidance was 95.0% to 95.75%. The weighted average interest rate on the company's share of total debt was 3.3%, and the weighted average debt term was 8.1 years. Those balance sheet numbers matter because REITs are capital-intensive businesses. A strong industrial REIT does not just need demand, it also needs access to capital and a balance sheet that can survive cycles. Inside a Roth IRA, this kind of REIT may function as a growth engine for the real estate bucket. But there are risks. Industrial demand can slow. Development can become less attractive, valuation can get stretched, and interest rates still matter. Industrial REITs can add a growth engine to a Roth IRA real estate bucket, but data center REITs take the growth idea even further. Data center REITs are another category that some investors consider for a Roth IRA. The reason is long-term growth potential. Data centers are tied to cloud computing, enterprise data demand, digital infrastructure, and AI-related infrastructure needs. Equinix is one of the major examples in this space. For 2026, Equinix guided for AFFO per share of $42.31 to $43.11. That represented expected AFFO per share growth of 10 to 12% on an as-reported basis. This kind of growth profile can be attractive inside a Roth IRA because the account may help long-term compounding work more efficiently. But growth REITs still bring different risks. Valuation risk can be high. Capital spending can be high. Competition can be intense. Power availability and capacity constraints can matter. And if investors overpay for growth, the tax advantage may not be enough to save the investment outcome. A Roth IRA can be powerful for compounding, but growth REITs still need the right price. So now that we have examples of REIT categories, we need to talk about what not to put inside a Roth IRA. Not every REIT belongs inside a Roth IRA. This is important because some investors hear tax-advantaged and immediately start chasing the highest yield. That can be a mistake. A Roth IRA can shelter taxes, but it cannot shelter you from bad investments. Be careful with yield traps. Be careful with REITs that have uncovered dividends. Be careful with weak balance sheets. Be careful when AFFO is falling. Be careful with sectors facing weak tenant demand. Be careful with too much debt. And be careful with REITs that are simply too expensive. A high dividend yield can be attractive, but sometimes the yield is high because the market is pricing in real risk. Maybe the dividend is not safe. Maybe the asset quality is weak. Maybe the sector is structurally challenged. Maybe the balance sheet is stretched. An asset advantage account does not fix those problems. A Roth IRA can shelter taxes, but it cannot shelter you from bad investments. That brings us to the broader idea of asset location. Asset location is the idea that the account matters. It is not only about what you own, it is also about where you own it. Some investors prefer holding REITs in tax-advantaged accounts because REIT dividends can be less tax-efficient in taxable accounts. That can make a Roth IRA attractive, but Roth IRA space is limited. So the question is not only, is this REIT good? The better question is this the best use of Roth IRA space? That is a much better framework because inside a Roth IRA, REITs are competing with other assets, stocks, ETFs, bonds, growth assets, dividend stocks, and long-term compounders. If a REIT is mediocre, it may not deserve Roth IRA space. If a REIT is high quality, reasonably valued, and has a clear portfolio role, the case becomes stronger. The question is not just, is this REIT good? It is this the best use of Roth IRA space? Once you think that way, you can build a REIT allocation more intentionally. A simple Roth IRA REIT framework does not need to be complicated. One bucket can be core diversification. That could be a broad REIT ETF. Another bucket can be income. That could include high-quality dividend REITs with durable cash flow and covered dividends. A third bucket can be growth. That could include industrial or data center REITs if valuation makes sense. The goal is not to own every REIT. The goal is to own the right role. A broad REIT ETF can reduce single company risk. An income REIT can support cash flow and reinvestment. A growth REIT can add long-term expansion potential. But discipline matters. Avoid overconcentration. Reinvest dividends intentionally. watch valuation, review fundamentals, and keep the real estate allocation balanced with the rest of the portfolio. A Roth IRA can be powerful, but it should still be part of a broader plan. The goal is not to own every REIT. The goal is to own the right role. Now let's cover the common mistakes investors make with Roth IRA REITs. There are a few common mistakes investors make when putting REITs inside a Roth IRA. The first mistake is chasing the highest yield. A high yield does not automatically mean a good investment. The second mistake is ignoring total return. Income matters, but price performance and business quality still matter too. The third mistake is over-concentrating in REITs. A Roth IRA can hold REITs, but it does not have to become a real estate-only account. Another mistake is buying a REIT only because it looks cheap. Cheap can become cheaper if the fundamentals are deteriorating. Investors also ignore valuation. They ignore dividend coverage, and they sometimes treat tax advantage as if it were the same thing as investment quality. It is not. Tax efficiency is not a buy signal. It is a wrapper advantage. The underlying investment still has to make sense. The Roth IRA helps with taxes, not with bad investment decisions. And before the final verdict, this is a good place for a quick channel pause. This is the kind of REIT and retirement investing analysis we focus on at Boring Money Wins. Not just chasing yield, not just buying whatever pays monthly, and not just saying Roth IRA equals automatic win. The goal is to understand the full picture: REIT cash flow, dividend coverage, taxes, Roth IRA roles, valuation, asset location, and long-term portfolio fit. If you like no-hype REIT analysis that explains both the opportunity and the risk, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want long-term investing without the noise. Now, let's finish with the final verdict. What are the best REITs to hold inside a Roth IRA? So, what are the best REITs to hold inside a Roth IRA? The answer is not simply the highest yield REITs. The best candidates are usually REITs or REIT ETFs with durable cash flow, covered dividends, reasonable valuation, long-term demand, and a clear portfolio role. For some investors, that may mean a broad REIT ETF. For others, it may mean high-quality income REITs, net lease REITs, industrial REITs, data center REITs, or a mix of income and growth real estate exposure. But the key is quality. A Roth IRA can make REIT income more tax efficient. It can help dividends compound. And it can be a strong home for real estate income if the investor follows the rules and chooses carefully. But it is not magic. It is not tax advice. It is not risk-free, and it does not turn weak assets into strong assets. The best REITs for a Roth IRA are not just the ones that pay the most. They are the ones worth compounding tax advantage for years. And boring money usually wins, because boring money usually survives.